Bitcoin truly is digital gold. I see it truly as the best store of value that's ever been created by mankind. If we go into a structural turn down and have a deep recession, we could see those deficits blow out from 2 trillion to 4 or 5 trillion. And the math is simple. You've got your entitlements can go up 10 to 20% and your tax base goes down 10 or 20%, and you're there. And then you're going from $37.5 trillion of debt today to 50 trillion, like that. It'll happen in just a couple of years. They print more money and they monetize the debt, just like they did in 2020 when they bought over $5 trillion of our own debt. So they'll do it again, but it's not going to be $5 trillion. It's going to be 10 trillion or more. Now you get above that 9% that we saw this last time, and you get to the 15%, 18%. But here's what they'll do. They'll let it ride for a little bit. You'll see the 70s and 80s again, where they just let that ride for a little bit to pay down past debt. That's the scary part about all of this. And I think you'll have 2 or 3 more of those echoes, and then you lose confidence in the currency altogether.
Just a reminder before we get started, this isn't financial advice. Know your risk tolerance, do your own due diligence, and speak to a financial advisor. Today, I'm joined by James Lavish, a former institutional hedge fund manager with 25 years plus experience in risk management. James writes a weekly newsletter, The Informationist, and helps run the Bitcoin Opportunity Fund. He's known for translating complex central bank plumbing and market structure into plain English, and for his clear-eyed framework on how liquidity drives risk assets from Bitcoin to big tech to commodities. James, it's great to have you. Welcome to the pod. You're one of the first Bitcoin maxis we've really had on, and you can, correct me if I'm wrong there, but most people still think of, BTC as a speculative risk asset. They don't understand, the real principles that make it sound money. And I'm wondering if you can just sort of take us through your journey with Bitcoin and how you view, what's commonly known as digital gold.
First of all, Bitcoin maxi, so it's become kind of a negative connotation. You see some of the Bitcoin maximalists who are attacking people on Twitter, X, whatever, constantly. So I would call myself a non-toxic maxi. There are some who love being toxic, and that's just, kind of it's a small faction of the Bitcoin community and believers. But so how did I get here? Like, what do I think of Bitcoin? I mean, like you said, I've been an institutional investor for now it's over 30 years, unfortunately. I have to update my bio, but I came from that traditional space of arbitrage and hedge funds and convertible bond arbitrage and risk arbitrage and that kind of world, and then moved into more private equity and longer term deep value investing later on in a different hedge fund. But when I came into this world of Bitcoin, I was completely skeptic. I was skeptical, just like everybody else. I'd heard about it in 2015, 2017, 2019. Actually, 2017, 2019 was when I really heard about it. 2015 was like a passing article, but I thought about it in 2019, like really had some discretionary capital that I wanted to kind of move out on the risk curve. And I had heard about this Bitcoin thing, started reading about it in the papers. It had run up to like 20,000, come all the way back down to 3,500. And so I did what you do as an institutional investor, and I went around and asked people, the experts in the so-called technology space. They were analysts from different investment banks, and they were analysts and portfolio managers from a few hedge funds. And by and large, every single one of them just dismissed it completely, and they said it's got no underlying value. It's a Ponzi scheme. It's going to go to zero. Avoid it at all costs, And so I did. I avoided it, and I did some other private equity investment that is still illiquid to this day, which, and who knows if that's going to be a zero or not, but, and I missed it. It was $3,500, and it's up obviously quite a bit since then. And so, but that's the way it goes. And now you fast forward to the pandemic, and I was leaving my hedge fund. I didn't know what I was going to do. And And my son was in college, and he had like this little group of guys that they would invest together. And so he was up at Cornell, and he's surrounded by some smart kids. And so he said, "Hey, Dad, I think there's something in this cryptocurrency space that might be there for you. If you're leaving your hedge fund, you might want to check that out." And so my first step in, Alex, was just trying to figure out the space. I bought some of the Ethereum and Cardano and Solana, all that stuff. And I just didn't understand. I bought a little bit of Bitcoin, but the more research I did, and the more I came to understand the protocol and how it's governed and how distributed it is, how actually decentralized it truly is, I realized it's the only one that's decentralized truly, and that it's completely standalone. It wasn't that it's just the oldest one or the new or the one that everybody knows the best. And that's not the point. That's not why Bitcoin is a $2 trillion asset. It's because of the protocol. And so as I started to learn this, I moved my money out of the other protocols and fully into Bitcoin, and started the Informationist newsletter and just talking about different macroeconomic, topics like you said, and unraveling them for common, just like everyday people. But the more and more I was writing, and the more and more I was researching, the more I realized that Bitcoin truly is digital gold, which gets you to your point, which is, how do I see it? And I see it truly as the best store of value that's ever been created by mankind. Gold is it's a base metal. There's only so much of it in the earth. We don't know exactly how much, but you can extrapolate. And it grows according to the price of it and how much demand there is for mining, and demand there is for sound money. We're seeing more demand now. We'll talk about that in a minute. But as far as Bitcoin's concerned, it has properties that gold doesn't have. It's easily verifiable. You don't have to do tests on it. You just look on chain. You could see that there's a transaction. That's it, and it's immutable. Those transactions cannot be changed. It's a time chain of cryptography that delineates all the transactions that have ever occurred, and they're attached to every single transaction. So if you try to put forward the transaction that doesn't match all the other nodes and all the other chains, it doesn't. It gets rejected. And so it's immutable. You can't double spend. I can't give you some and your producer some and claim that it. So it's also very easily transferable. If I wanted to move $1 billion of gold, it would require me to get some people to move it out of a safe, onto a truck, onto a train or a boat or planes, plural, in order to move that much weight and that much gold. And it would require security and time and a lot of cost, a lot of energy. Whereas Bitcoin, if I wanted to move $1 billion right now, it would take about approximately 10 minutes, and it would cost a few bucks. It'd be easy to do. There is that liquidity, and there is that the ability to do that. So things like that people don't realize that Bitcoin is governed by and is protected by. And finally, the biggest part of it all is that because it's a proof of work, it's a proof of work protocol. It means that you have to expend energy in order to put forth a transaction. And so the amount of energy that Bitcoin uses is the equivalent of 80 terawatt hours. I think it's 81 terawatt hours annually, which is for those non-engineers, and I'm not an engineer, but that's the equivalence of 21 full-scale nuclear reactors running 24/7. And so the protocol is protected by this. It is nation-state level resistant. So you can't just change it. A government couldn't just come in and decide they want to buy a bunch of Bitcoin and change the protocol. It doesn't work that way. It's governed by that fortress of digital energy is basically what it is. And then for those who worry about the energy use, because of the nature of the cost of Bitcoin mining and the cost of the coins, Bitcoin gravitates to the energy that's not being used. It's wasted energy. It's like associated natural gas from oil wells that they would just burn off into the atmosphere. Well, Bitcoin uses that instead and makes the oil grid, the energy grid, even more green. You've got wasted, you've got wasted energy for solar or wind, where you wouldn't be able to build those wind farms or those solar farms if you didn't have a way to use some of this energy, unless you were just going to store it, because you've got to get rid of the energy somehow. Otherwise, you can't have as much of a grid as you want. So Bitcoin enables you to build out a full grid that you can then you can anticipate growing into as a community or a city or a state, and then Bitcoin will use the energy. So if you've got that full scale wind farm that you're trying to build, Bitcoin will use that energy, and then when you need it, when you have a spike of energy need, like in the 110-degree summer in West Texas, then you can turn off your miners and just give that energy back to the grid. And so we're actually doing that in one of the companies that we own in the Bitcoin Opportunity Fund. And so so that's a huge arc of why I believe in Bitcoin and why some of the stuff you hear about it is not true.
Yeah. Yeah, I missed it as well too. I was writing about it, sub 1,000, but I just never took it seriously till a few years ago. I didn't do that deep dive. And like you, it was my younger brother who kind of got me interested in it, right? And everybody sort of seems to have a story of somebody younger than them saying, shaking them kind of awake,
pay
right?
attention. Yeah,
exactly.
It was my wife had heard a podcast of Tim Ferriss,
okay.
And I don't know who was on. They were talking about Bitcoin. She's like, "You've got to check into this." I was like, "Listen, sweetheart, I'm the investor. I'll do you."
Yeah.
That's cute. And
should have listened, man.
That was the word. I should have listened back in 2017.
Yeah, no kidding. You made an interesting comment there that communities have almost too much energy or excess energy. The IEA has said that globally electricity demand is expected to double by 2050, right?
Yeah.
So we don't have enough copper. I mean, the world is kind of racing to create, more energy, more electrification. What's your theory there? Like, what data do you have to sort of back that up? And why are these mining companies voluntarily turning off their mining, operations at certain times of the year? One of the biggest frustrations investors have is taxes. You make the right call on a stock or that explosive crypto trade, and then boom, half the gains are taxed. You took the risk and won, but the government takes their share of your gains. That's why I'm excited to introduce our sponsor of the pod, iTrustCapital, the #1 crypto IRA platform in America. They've built a self-directed IRA platform where you can actually buy and sell crypto, gold, and silver inside a tax-advantaged IRA. Trades inside an IRA are not taxable events under IRS rules. And I think the best part about iTrustCapital is they use the same institutional grade custody for crypto that BlackRock relies on. Now that's peace of mind. And they do it with no monthly fees, just a simple 1% transaction fee. Real US-based customer service, security, and real tax advantages. iTrustCapital gives US investors the ability to hold the actual assets like gold, silver, and crypto directly in an IRA. You can fund an account with a cash contribution, transfer an existing IRA, or even roll over an old 401k or employer plan to take more control of your future. So if you're looking to protect and grow your retirement with crypto, gold, or silver, check out our custom link in the description and be sure to use the promo code PINNACLE8 to claim your $100 funding bonus when signing up and funding a new IRA with at least $1,000. As always, all investments carry risk, and this isn't financial advice. Now, let's get back to the pod.
Yeah, it's a good question. So there isn't too much energy across it. I mean, we need energy to grow as a population to grow our efficiencies. That's just reality. You can see population growth goes up with energy demand goes up with it, and they're very closely correlated. But you have wasted energy in pockets around the world, whether it's from things like the oil drillers in particular out in areas that are non-urban, clearly, or up in Calgary and Western Canada. When they drill and they frack for oil, they get what's called associated natural gas. They get this natural gas that is out in a field far, far away from any urban center. And so in order to get it back to anywhere where it could be used, they would have to either truck it or build pipelines. But natural gas is not worth enough. It's not, there's so much of it that the demand for it doesn't make it cost effective to build that. So what do they do instead? They just burn it. They burn it into the atmosphere. And so it creates, pollution. But instead of doing that, we can hook up generators that will use that natural gas to mine Bitcoin. Okay, so that's one instance. That's typically not an area where you're going to turn off the miners to give the energy back to the grid, because that's just stranded. It's stranded energy. You also have stranded energy in areas where they have water turbines, right? So exactly, hydro. And so, but there's just not, they build it, but there's not enough of a demand near it to get that energy to where it's needed. So we can use that. And then finally, but what you're talking about is the excess energy, right? And that's created when you have these massive wind or solar farms in a place that, to pipe that energy back, it's extremely expensive. So we're using massive wind farm out in West Texas in one of our companies that they built, but they didn't pipeline it to get back east. So they've got this gigawatts of stranded energy out there, like somewhere between 6 and 8 gigawatts of stranded energy. It's just sitting out there, and they can't do anything with it. So the question is, do you just shut it down? Do you build that pipeline, or do you use a customer that can give that energy back to the grid when you have the spikes that you may need it at times, that makes it cost effective? Why would we do that? Well, it's in our energy agreement. It's in our agreement that we buy the energy, and then we can turn off the Bitcoin mining and sell it back to the grid. It's not as good, but it's not up to us. It's up to if the state needs the energy or the city needs the energy, they get it. And so that's the agreement. So it's built into it. So that's where the need to build out these things, you're going to either have to have massive batteries. So you'll have a field of turbines and of wind or solar energy, and then you'll have a field of batteries somewhere to store it in order to send it back to the grid when you need it. So that's not cost effective. And so the Bitcoin mining actually makes these projects cost effective, and it allows those the huge urban centers to build enough that they'll be able to deal with the demand from a place like Lubbock when they need it. Mm-hmm.
What happens, James, when the Bitcoin mining ends? When is that last? Yeah, 2140. When that last coin is minted, what happens then?
Well, then the transaction fees are what is going to keep the Bitcoin space still active. And so the fees will go up from here, because you're going to have to demand.
Transact, or to send money to transact.
Yeah, I mean, we're talking about a long time from now. We're talking about over 100 years from now, 115 years from now. Mm-hmm. It will happen between now and then that fees will. Fees are becoming a larger and larger part of that reward for miners to mine that block. Mm-hmm. But then once you start doing transactions, the signer of the transaction they'll win that block. And so that's a 10-minute block. They'll no longer get a reward; they'll just get the fees for it. And so that's how that will work. But it's still going to be governed by the miners and the nodes that sign off on the transactions.
I want to zoom out kind of and look at the space, a little bit bigger here. I think the reason, so much is happening right now, you have gold going to new highs, bond yields spiking, is the U.S. government can't pay its bills. Right. And I've heard you talk about this before. You have a very interesting theory here. I'd like you to just kind of lay it out for us.
The debt crisis. So this is just reality. This is just math. We're in a debt spiral. Why is that? Well, it's because we spend as a nation, our government spends $7 trillion a year, and our tax base is only $5 trillion. And so we're operating with a $2 trillion deficit. So the easy thing to say was, well, let's just go cut costs. Let's go cut unnecessary programs, unnecessary expenses. Well, the issue there is, and we just saw with Doge, is that there's only so much you can cut, and it's like moving around chairs in the Titanic. It's not going to do anything.
Yeah.
So the bigger issue is that we have, when you put together the entitlements, the entitlement programs, Social Security,
Unfunded
Medicare,
liabilities.
Medicaid. Yeah, and you have the unemployment and all that. Yeah, all of that gets put into a mandatory bucket. Those are expenses the government makes. This is all Congress. This is not the Treasury. The Treasury enables it through their borrowing, but this is Congress. When you put all that together, and then that's over $3 trillion. When you put all that together, and then you add on the two expenses that are also not signed into legislation, but they are necessary, are number one, defense. The defense spending is we're not going to see that slow down anytime soon. That's just under $1 billion or $1 trillion.
A trillion, yeah, a trillion.
Yeah, so it's about $850 to $900 billion that we know of. Just put that there. So, but then you add on the interest expense on our debt. You've got to pay that, because if you don't pay that, you default on your debt. You declare bankruptcy as a nation, and you'll never be able to issue debt in your own currency again. We see that with emerging markets all the time, especially in South and Central America. So, but put it all together, and now you've got your $7 trillion when you add on your discretionary expenses. So even if you cut every single discretionary expense, you're still spending more than you're taking in. Okay, so there are obviously three different things you can do, right? There are three ways you could solve this problem. The first thing you do is austerity, right? So you just cut spending. Well, each party tries to trick the other party into doing this somehow, but you just heard the math. The only way they can do that is by cutting entitlements. It's just not going to happen. They try to trick each other to do it each time. It's just not going to happen. So you're already over the limit. Like you can't, there's no way that you can cut to get there. It's just not going to work. That's number one. Number two, and it's political suicide. I mean, remember that our congressmen and senators, they can be there forever. There's no term limit. So their chief focus, their driving force, their incentive is to be elected again. So that means they've got to do things for their constituents. That's why you see Elizabeth Warren and some of the other senators take so much money from some pharmaceuticals, and then you see them fighting for them in Congress. It's mind-boggling, but that's why. It's not conspiracy. It's reality. It's just it's incentives. And then, forget about both parties. Both parties have demonstrated they suck. But, the issue here is the incentives. So that's not going to happen. The second thing you do is raise taxes. Well, we all know the Laffer curve, where you can only raise taxes to a certain amount, and then it starts driving productivity out of your tax base, and it flees the country. And so your productivity goes down, and the amount that you're taking in taxes, that's even worse, because now you get to the same place you were in the first place on your tax base and the amount of tax dollars you take in, but now it's worse because you're on a declining curve. So that doesn't work. And then the third thing you can do is just default. All right, you could just default on your debt, write it down, say you're going to give you 50 cents or 30 cents on the dollar to all the bondholders, and start over. Well, if you do that, then you can't issue debt in your own currency anymore, because people won't trust it, right? So, and we have seen that happen in Argentina and Venezuela and other countries. So that's not going to happen. So the last thing you can do, and that's a hard default, but the last thing you could do, Alex, is a soft default, which is by allowing for strong and high perpetual inflation. What you're doing is you're growing GDP nominally, because everything's in higher prices, right? Issue more dollars, print more money, and you through liquidity and debt and all of that, and then you grow your GDP. So then in the future, you're taxing more dollars. They're worth less against the debt you issued 2, 5, 7, 10, 20 years ago, 30 years ago. So now you're paying down that debt with cheaper dollars. And it's called debasement. And so, and that's the only thing that we've been able to do recently is just debase, and we've seen quite a bit of it recently.
Yeah. Now the dollar lost a huge percentage of its value in the 70s, right? They did this in the 70s. Volcker brought in, had to take interest rates to 20%, right, to save the dollar.
Yep.
How long can we play this game, James, before inflation, gets out of hand and it's not, the 3, 5, 8%, whatever it's been the last, 5 years, and we lose control?
That's another good question. So when a currency fails, it loses control. You have hyperinflation. Well, that means that you've lost confidence in the currency completely, right? And we saw it in Weimar Germany. You've seen it in other areas around the world. But what you're talking about is hyperinflation. And I think that's a long way off. And the reason for that is the dollar is the most accepted currency in the world. It's the global reserve currency. And that's why you've got the U.S. Treasury is a global reserve asset, because people want dollars. That's the most stable of the currencies. It's the one that is most trusted in the world. So what will happen is you'll see other currencies fail first because of this fiat experiment. What happened was we got off the gold standard, as you well know, in 1971 with the Nixon shock. He took us completely off the gold standard. And since then, we've seen the money supply grow in the U.S. at over 7% annualized. That's not the 2.2% or 2% annual inflation that the Fed and the government admits to. It's far higher than that. And so what happens here is you're going to have, we will have another event. I mean, I'm a little bit older than you, but I've lived through, in high school was 1987, the Black Monday crash. And then flash forward, I'm on Wall Street, and just a few years in, we have the 1998 Russian ruble crisis, which led to the long-term capital management implosion, which almost took down the entire financial system, right? Yeah. Then you've got the tech bubble of 2000, 2001, right? And then you've got the September 11 that's right on the backside of that. Then you've got the great financial crisis just 7 years later. Then you've got the pandemic, which was it was about a decade later from there. And so we're seeing 100-year events every 5 or 10 years. I mean, it's just what it's been. And so I expect that there will be another 100-year event. On the backside of that, the math I just laid out for you sets up the problem. The problem is, if we go into a deep recession, if we have a steep drawdown in the financial markets, which this country is extremely financialized, and the stock market is a very big part of our economy. And so if we go into a structural turn down and have a deep recession, we could see those deficits blow out from 2 trillion to 4 or 5 trillion. And the math is simple. You've got your entitlements can go up 10 to 20%, and your income goes down, your tax base goes down 10 or 20%, and you're there. And then you're going from $37.5 trillion of debt today to 50 trillion, like that. It'll happen in just a couple of years. Yeah. And as we're already on the path that our debt with this math doubles every 10 years. And the CBO is admitted to it. They know it. Yeah, the Treasury knows it. It's unsustainable. So what happens is they can't allow that to happen, because it will impact the Treasury. So what do? They print more money and they monetize the debt, just like they did in 2020 when they bought over $5 trillion of our own debt, right? So they'll do it again, but it's not going to be $5 trillion. It's going to be 10 trillion or more. And so what happens? Yeah. You have more inflation. Now you get above that 9% that we saw this last time, and you get to the 15%, 18%. But here's what they'll do. They'll let it ride for a little bit. You'll see the 70s and 80s again, where they just let that ride for a little bit to pay down past debt. And that's the scary part about all of this. And I think you'll have 2 or 3 more of those echoes, and then you lose confidence in the currency altogether.
Yeah. the world reserve currency is what most people come back to and say, that's why hyperinflation is a lot further down the road. But when you look at bond yields, you look at the 30-year this morning, you look at the 10-year, there aren't any guarantees that the rest of the world is going to go along with. Like if they start demanding 6, 7, 8% or higher, you talk about interest on the debt.
That's
we're going to get to that 50, we're going to get to that 50 trillion number pretty
quickly. Yeah.
Right. And then, how quickly can you lose confidence at that point? Right.
We're already seeing the confidence being lost. You could see that there are central banks around the world that are not buying U.S. Treasuries. They're buying gold.
Yeah.
That's an issue. Now,
for the first time, their reserves have now exceeded U.S. Treasuries.
That's right. And so there are people out there who believe that the BRICS are going to create their own competing currency. I don't think that that's true. I don't think that they're organized enough or trust each other enough. I mean, can you imagine if they create a currency that is backed by gold, for instance? Do you think Xi is going to let Putin into the Chinese vault to audit the gold? Of course not. So who's going to be able to audit that or trust that? I just don't see that happening. You've got a bunch of dictators or autocrats. I mean, it's just not going to happen.
No.
But they can stop buying U.S. Treasuries. And so one of the critical mistakes that the last administration made was shutting off Russia from the SWIFT system and seizing their U.S. Treasuries. That just signaled to the world that if you don't do what we like as a nation, then we may just seize your assets. Well, who wants to own U.S. Treasuries unless you're a very, very close ally of the United States? That's another impact to that.
So the U.S. Treasury is always looking for buyers. They don't want the Fed to be the buyer of last resort. Right. Define stablecoins, define Tether, and how the U.S. Treasury might somehow find a ton more buyers for their debt to kick this crisis down the road.
What these are, the stable coins, what they are is they are pegged. They're digital currencies that are pegged to a unit. And that unit could be gold, it could be copper, it could be anything, and typically what it is it's the US dollar. Because everybody wants US dollars, right? So you could peg it to anything. But by and large, stable coins are the vast majority of them they're pegged to the US dollar. So what does that mean? That means that if you buy a stable coin, then you're going to get US dollar worth of a stable coin. You sell it, you're going to get a US dollar worth. So no matter what happens to the dollar, you're getting a dollar. So even if you're in Italy and you decide that you want to buy a US stable coin, you take euros, you buy Tether, it's tethered to the dollar, and now you effectively own dollars. Okay, so what does Tether do? Tether have to be pegged to the dollar, right? So what they do is they buy US dollar denominated assets. And primarily that's short-term treasuries. That's T-bills. So it acts kind of like a money market. But the difference is you're not getting the float on that. You're not getting a yield on that like you do in a money market. You're just getting that stabilized US dollar. And so Tether's getting the profit. So Tether's making billions of dollars with just a handful of employees. It's like one of the most, if not the most profitable company per employee in the world. So why is this all important? Last year we went up to Congress and we met with senators and congressmen and their aides and talked about these different cryptocurrencies, and we were teaching them about them. But what we learned is that they had already met with stablecoin providers. They had already met with Tether, and they knew how important these were. Okay, so it came out and we started realizing over the course of the last couple of years and now into this year that Tether is one of the largest buyers of U.S. Treasuries in the world, top 10 buyer. And so they are a necessary part of the equation for the U.S. Treasury now. Why? Because what I just described to you could happen in Italy, but could also happen with any of the unbanked that you talked about in the beginning of the show, which there are over 1 billion people who don't have bank accounts. And so they could be anywhere. They could be in an African country. They can be in a small Asian country. They could be anywhere. And what do they want? They want dollars. It's likely that their currency is inflating or hyperinflating against them. So the Treasury knows, Congress knows that this is a way to find pockets of liquidity all around the world that we don't have right now. So when you look at demand for U.S. Treasuries in the auctions, they're by and large, the largest international buyer is the Cayman Islands. So who's in the Cayman Islands? They're hedge funds. So it's not really central banks who are buying these things like they used to. It's far lower than it used to be. So, and that is concerning to everybody in Congress and the Treasury especially, which is why they keep warning Congress that they've got to stop spending because they can only keep up the charade for so long. They're on what they've already deemed an unsustainable fiscal path.
Yeah. You mentioned liquidity there and kind of got me thinking, right? You liquidity rules all is one of your famous lines, right? Mm-hmm. And we're seeing the job market, kind of the labor market, start to deteriorate here a little bit. M2 is moving up, and risk assets have been performing well. Do you see any change to that? Talk to us about, the Fed, the Fed is meeting here in a week's time. Obviously, everyone's baking in a quarter-point cut. Mm-hmm. Talk to us about the liquidity picture. Where do you see things there?
All eyes are on the Fed, right? So, there's an analyst that I talked to quite a bit, Michael Howell from Cross-Border Capital, and he is my favorite go-to for understanding what's going on in liquidity around the world. It's not just the money supply; it's liquidity, it's global liquidity, and his model, it's proprietary. I don't even know exactly what the calculation is, but his model, which I've found is one of the, if not the best out there. It takes into account all kinds of types of liquidity. It's the money supply. It's central bank liquidity that's being created through QE or other projects they have all kinds of acronyms for them, right? The BTFP, that stuff. But and then it's also it's bond liquidity and volatility, and that in turn will create a situation where if bonds are very volatile, then you need more collateral for them to buy them for leverage or for margin. So that if the higher the volatility, the more margin is required, the less liquidity there is. So that's a really important part of the equation. And then, collateral values and the shadow banking market, which is the hedge funds and private liquidity, private funds. And so and we see a lot of private debt now. Mm-hmm. And so those are all taken into consideration. So to answer your question, it's about a 6 to 7 year cycle. And we're nearing the end of that cycle right now, which estimated to be somewhere around the end of 2025. And so that's a really important driver of all of these markets. And so as we end that liquidity, after that liquidity will be drawn out. But we're seeing right now, the Fed is about to ease liquidity by lowering interest rates. And the only question is do they come in with QE again? How bad does it get? So that's why all eyes are on the Fed and all eyes are on all of these data points, the job numbers and the inflation numbers that are coming out in the next couple of days.
Right. So are you expecting a decline in asset values then, like Q1, like in the first half of 2026?
Yeah. So if that liquidity cycle plays out, and there are smaller liquidity, movements in between. So it's not just like one way or another. It's like, it's an ocean liner, right? So it's moving slowly, which is the 6 or 7 year cycle. But I do expect that liquidity will start to contract here at the end of the year globally. The U.S. may be expanding, but you're already seeing it contracting in other areas. So if that happens, then yes. Now, risk assets, things like gold, Bitcoin, stocks, they tend to lag that. Stocks are a little bit closer to it, but Bitcoin and gold will lag it by about 10 or 12 weeks. So you'll see the Bitcoin price, you'll see liquidity expand, and then Bitcoin waits about 10 or 12 weeks, and then starts to expand afterwards. The same thing with gold. But gold's gotten a little bit ahead of itself for a few reasons.
One of the biggest frustrations investors have is taxes. You make the right call on a stock or that explosive crypto trade, and then boom, half the gains are taxed. You took the risk and won, but the government takes their share of your gains. That's why I'm excited to introduce our sponsor of the pod, iTrustCapital, the #1 crypto IRA platform in America. They've built a self-directed IRA platform where you can actually buy and sell crypto, gold, and silver inside a tax-advantaged IRA. Trades inside an IRA are not taxable events under IRS rules. And I think the best part about iTrustCapital is they use the same institutional grade custody for crypto that BlackRock relies on. Now that's peace of mind. And they do it with no monthly fees, just a simple 1% transaction fee. Real US-based customer service, security, and real tax advantages. iTrustCapital gives US investors the ability to hold the actual assets like gold, silver, and crypto directly in an IRA. You can fund an account with a cash contribution, transfer an existing IRA, or even roll over an old 401k or employer plan to take more control of your future. So if you're looking to protect and grow your retirement with crypto, gold, or silver, check out our custom link in the description and be sure to use the promo code PINNACLE8 to claim your $100 funding bonus when signing up and funding a new IRA with at least $1,000. As always, all investments carry risk, and this isn't financial advice. Now, let's get back to the pod. Bitcoin has been leading these liquidity cycles, right? And is BTC still, the highest beta expression of dollar liquidity? And you talked about the dollar, them increasing the supply 7% a year, right? So do these assets have to fall if they're continuing to debase the currency, or will they continue to outperform, inflation?
Yeah, that's a good question. Bitcoin has been the tip of the risk spear for years now. And you typically see when Bitcoin makes a move, then the NASDAQ follows. And it's been it had been correlated. But now if you look at Bitcoin, it's kind of uncorrelated to anything. It's becoming less correlated to anything. It's kind of moving by itself. And it's moving more in tandem with global liquidity than anything else. Again, on a lag. But I do expect that if we have a downturn, when we do have a downturn, that Bitcoin's going to go along with it. It is still considered a risk asset. And so it will drive lower along with it. It depends on how sharp that drawdown is too, and for what reason. If you see a sharp drawdown in all the markets because of some sort of event that's an economic event or a natural disaster or something, then you would see everything go with it, including gold. And the reason for that is that institutional investors sell what they can. So not what they want to, and especially when you come in on a Monday morning, there's been a disaster over the weekend, then you walk into your desk and you're like, just take 10 or 20% off. I don't care. Just sell 10 or 20% of the entire portfolio. Let's see where we stand. Yeah. And the reason for that is, again, going back to collateral. Because these investors typically run on margin. And so even if you're a pension fund or an endowment, that this is happening, you do the same thing. You're going to get ahead of it. Mm-hmm. But the hedge funds and private funds run on leverage, sometimes quite a bit more than Reg T, which is just 50%. But the issue here is that collateral requirement, which is called the haircut, it will move dynamically. And so when you have a drawdown in the markets, you walk in, you used to have to put up maybe 5 or 6 or 7% of a trade for a blue chip stock. Your prime broker saying you got to put up 20% now. And it happens overnight. And so they move the goalposts on you, and that's it's in your agreements, and it's very difficult to get an agreement that doesn't do that. And so it's called portfolio margining. So they just sell what they can. It's like just get out of it. So that means everything correlates to one. You know this. A lot of your listeners know this. Now, what happens when the Fed then comes in with the Fed put and they start printing money and announce QE? Well, everything starts to go up again. So you get that V-shaped recovery that we saw in 2020.
In April, yeah.
So it's the same exact thing. So, and Bitcoin, gold led the way up, then Bitcoin followed and screamed past gold for years. And so that's one thing. But what if you have an event that's more like Silicon Valley Bank? So if you go back and look at what the performance of these different assets during the Silicon Valley Bank implosion, well, Bitcoin actually was a recipient of that. So of that liquidity. So what happened? Well, you have a regional bank that highly consolidated. They had too many treasuries, longer term treasuries that were marked down so significantly that they didn't cover their deposits, and so there was a run on the bank. Well, then people started getting worried that their regional banks were also going to get, have a run on the bank, and then they wouldn't be covered by the FDIC insurance, and that maybe FDIC would fail, and so they wouldn't have the money, and so what would happen? And so people started getting worried that their deposits would either be seized by the bank in order to pay off the investors of the bank, and not the customers, or they would be marked down, like we saw in that happened in Greece back in the Great Financial Crisis.
Yeah.
Post Great Financial Crisis, they did that.
Yeah. They only got 10-20% on the dollar or whatever.
Yeah. So people's savings were completely wiped out. Their life savings, they were just taken and they were given to investors instead, or they were worried that it would just disappear. And so what did they do? They bought Bitcoin. So you saw Bitcoin go up 25 to 30% in the month aftermath of that. While you would have expected, with the downturn of the markets and everything grinding lower because of fear, you would have expected Bitcoin being the tip of the risk spear, the same thing. But Bitcoin had already bottomed out. It had already had its large drawdown from the last cycle, and so it was an opportunity. And people saw it as, hey, this is a place where I can tuck away money that I know it's at least going to be there. It may be volatile, but it's also volatile to the upside, which is actually a benefit.
No one can confiscate it.
No one can confiscate.
So as the liquidity cycle ends, you're not forecasting a Bitcoin winter or a crypto winter. What does that look like? What is the other side? I mean, it's obviously exactly.
I do think that we're going to have another drawdown. I at the same time, I think that volatility is going to continue to dampen here for Bitcoin because of the institutional interest in it now. Now that you've got these ETFs, the largest growing ETF in history, IBIT, blew away gold's record of gathering assets. It gathered $70 billion in less than a year. So that is indicative of institutional interest. As that interest and knowledge base grows, you're going to have more and more institutional investors. Well, what does that mean? So people want to understand what that means mathematically. Well, why does that dampen volatility? They could still sell it. Of course they could. But if and when Bitcoin becomes a separate asset class that is being allocated to within the portfolio, then what happens is that the institution has a target portfolio allocation, and as Bitcoin goes down, that allocation becomes underweighted to what they want. So they'll buy some in order to top it back up, and as it goes up, they'll sell some to take it off the books because it's gotten too big of a position within the portfolio, and so it's just portfolio rebalancing. And so what will happen is that dampens volatility. So that just means, though, Alex, is that I still believe we're going to have what a so-called crypto winter. Bitcoin is going to draw down. I just don't think it's going to be the 75, 85% that we've seen before. I think it'll be more like 40 or 50%. I could be proven wrong, but that's what I believe. Unless we have a massive market drawdown and just record-setting turmoil, then I think that's kind of where we're headed with it, and that's going to happen starting at the end of next year, in my opinion.
Yeah, I think there's so many more people who have accepted Bitcoin as an asset class, versus the last drawdown. Of all the metrics, adoption for me seems to be one of the biggest ones. There's less than 1 million people own one Bitcoin. Yeah. Why do you think that is? So, I mean, adoption is really nothing. Yeah. And, you mentioned gold's sitting there at 24 trillion, flirting with 25 trillion. Bitcoin is over here, 2 trillion, less than 1 million people own one of them. Why haven't we seen, more adoption?
Yeah. So, okay, first of all, there's only ever going to be 21 million Bitcoin ever created. A few million have been lost already, and people lost their keys, whatever, and that's just a casualty of the growth and emergence of this new
That guy in the UK who's still looking in that dump for his $8 billion. That poor guy, man. They finally shut him down. He was out there with a shovel for like 10 years. They finally just said it's over, man.
You lost $1 billion in your trash. It's crazy.
Brutal. Anyway, go on.
But let's talk about that. Fewer than 1 million people own one full Bitcoin. Well, that's by design. There's only 21 million that will ever be made, and so you're only at 19 and some odd here. So, but what's important about that is there's 61 million millionaires in the world. If they all wanted one, they could, even if every single person who was not a millionaire sold theirs to them, they could still only have 1/3 of a Bitcoin each, at most, ever. And so, but each Bitcoin can be split into 100 million pennies called Satoshis. And so it's almost infinitely divisible. So it could serve the whole world, okay, that 21 million Bitcoin. Yeah. Mm-hmm. But the adoption, it's been growing since 2009, right? And it has already gathered $2 trillion in its ecosystem. So that protocol has $2 trillion in it right now. That's just mind-boggling if you think about it, right? So gold has been around, and there's this great chart by Jesse Myers. It shows that there's $1 quadrillion worth of assets in the world that are looking for, they're a store of value assets. They're looking for a way to keep value of your hard-earned money. That's not just sitting in the bank. You're actually in, you're doing something with it. Well, out of that 1 quadrillion, which is 1,000 trillion, 129 trillion is still stuck in money, in just money markets and that stuff. But you've got bonds are 318 trillion, real estate's 370 trillion, equities are 135 trillion. You've got art and collectibles, which are about 27 trillion. You've got gold is about 22 trillion, which is a little higher now because it's up a bit from when this chart was made. But gold, listen to what I just said. Gold is about 22 trillion. Gold has been around as a store of value for thousands of years. And it's 22 trillion out of that 1 quadrillion. And Bitcoin is 2 trillion. It's already 1/10 the size of gold in just 15 years. That's mind-boggling. And so what you're witnessing is the adoption of a new technology and new store of value. And that's why it's so volatile. Gold had the same volatility when it was being adopted. It's the same thing. And there's nothing, I have nothing against gold. I actually own gold. I'm a believer in it. I'm a believer in hard money. But like I said, Bitcoin's got advantages that gold doesn't have. And so it is taking market share from gold. Yeah. But it's primarily been taking market share from equities, that equity bucket as a risk asset. But what's going to happen is it's going to continue to take market share from gold, and it's going to start taking market share from real estate as people realize, man, buying real estate, holding on to it, managing it, paying for the management, paying for the maintenance. Yeah. It's expensive. It's time consuming. Yeah. It may be worth it for me to be working on something else while I just invest that extra capital, that excess capital I have in Bitcoin, and let it grow and store its value against the money supply instead, or against that liquidity supply instead. Real estate has its other positives I'm not going to knock on. Of course, it's got tax advantages, it's got income advantages. So, but for those people who are just using it as a store of value, they're going to start realizing Bitcoin's a lot easier to hold as a way to protect yourself against the exceedingly quick expansion of the money supply. So, but all of these will grow too as you see that. So that 1 trillion, that 1 quadrillion become 2 quadrillion. Right. And so that's part of the calculation too.
Fascinating. Why do you think gold has been outperforming Bitcoin, in the last 12 months? And I mean, the gold miners especially have been, hugely outperforming Bitcoin in the last 12 months. What do you think's behind that?
Yeah. Well, first of all, obviously what we talked about in the beginning, which is you got central banks who are buying gold hand over fist. and they're buying them instead of treasuries. Again, red flag. We should be very aware of this and take note of it. And the Treasury does know. And so that's been, again, it's been a store of value. It's been a great store of value for thousands of years. And if you want to buy, I think it's the calculation is about 400 loaves of bread. Your listeners will know better than me if they're gold investors. But what do people do when there's uncertainty in the world? And you start getting a little bit anxious about the PE ratio of the stock market, and the stock market all-time highs. Where do you put your money when you're worried about, oh man, I'm not sure I want to own long-term treasuries? Because what if we do have a spike of inflation and those yields go from 4% up to the 5 or 6% you're talking about? That would destroy the value of those long-term treasuries. Don't want to do that. So where can you store it? Well, where can you hide? Gold's a good place to hide in uncertainty, especially as you come into uncertainty around tariffs, uncertainty around geopolitical uncertainty. It's a good place, and it's telling you something. It's telling you people are a little bit worried about where they can store their value without it being either seized or melted away or just or broken down because of the structural issues of the way we manipulate the money.
Yeah. And why, central banks haven't really fared into the crypto Bitcoin ecosystem yet. Do you see that coming? Most Bitcoin maximalists believe, nation states are going to get in there. The central banks haven't. They've been buying gold.
Not that we know of. And so if you look, I don't know if there have been central banks who are buying. I would strongly suspect that there are a few that are accumulating. And so if you're the United States, are you gonna start buying Bitcoin and then announce it, or are you going to announce you're going to buy it and then buy it, right? Yeah. So it seems, even though I don't think the United States is out there actively buying right now, but it becomes game theory when you have one central bank that announces they bought some. Then it's a race for the central banks to get as much as they can because they know that it's only 21 million of them, and so it's a way for them to protect themselves. We have we've already had the strategic Bitcoin reserve that's been created. You can't add to it unless it's budget neutral. And so that was signed into legislation by Trump this last year. And so what does that mean? It means we can't sell what we currently have. And so about 200,000 Bitcoin that we currently have.
Yeah, that was confiscated, right?
It's confiscated from illegal or illicit activity.
That's right.
And then you've got we can't add to it unless we add to it budget neutral. So how do we do that? One of the obvious things to do is you've also got the sister executive order, which allowed for the holding of the other cryptocurrencies that were seized through illicit activity, whatever, but they can't buy it. So because of that, the obvious thing would be sell those and buy Bitcoin with that capital. That's one thing. But then you also have the Bitcoin Act, which is it's already been brought forward, and it was penned by Cynthia Lummis out in Wyoming, Senator Lummis, and now she's got co-sponsors of the bill, which she didn't have prior to this year. And so, but that's got to weave its way through a gauntlet of committee meetings and revisions and comment periods.
What do they propose to do? What is it the act
if that does,
yeah.
if and when, I believe it will get signed into legislation eventually. If it, as it is, it means that it's calling for the U.S. to buy 200,000 Bitcoin per year over 5 years to get to 1 million Bitcoin, which would be about 5% of the supply. And so just imagine if that happened, Alex. It just sets in motion for every other major central bank in the world to start buying Bitcoin. They need to. If the U.S. is going to buy it, what are they going to do with it? Well, it's going to be in their strategic reserve. They could start doing things like issuing bonds that have Bitcoin. They're Bitcoin-backed treasuries, and that's something that Andrew Hone has talked about. And Is it near term? No, I don't think. I think it's a little ways off. I don't think it's going to happen next year, but I do think it eventually would happen. So, and that's kind of what we're talking about here.
So you think the probability of that ultimately getting passed and going through is high?
I do. I don't know when. I don't think it's going to happen this year. Obviously, it's got a long way to go, but I do think it eventually does weave its way through. But I also don't think it's going to look exactly the way it does today. I think there's going to be a lot of there will be significant changes to it. What those are, I'm not sure yet.
There's going to be ups and downs, obviously, liquidity and the crypto space and everything else. But one quadrillion global assets. Raoul Pal believes the crypto space is going to go to 100 trillion, right, in the next little bit. There's all these different forecasts, right? Bitcoin's sitting there at 2 trillion, as you mentioned. Do you have how much size? How big do you think it can get? How soon?
Well, I mean, it moves in liquidity cycles, but I think the Bitcoin adoption, the way that if you're looking at the rate of adoption of Bitcoin and you would attach the probability of different metrics to it, like the power law and all of that, I think that it gets to $1 million per coin somewhere around 2030, 2032. And so it's not that far off. We're talking about 5 to 7 years. And so, that's almost a 10x from here, which means it'd be almost the size of gold today. So in that time period, though, Alex, I think that the money supply is going to expand significantly too, and that's part of it. So that's not in today's dollars. It's still in tomorrow's dollars. It's assuming the expansion of liquidity supply also. Yeah. Now, if we have an event like we did in 2020, 2021, we come back out with a money bazooka. That's going to change that calculation. It could go much higher than that. But yeah, I think it's just going to continue to grow in that way. And if you think about it, U.S. debt has been doubling every 10 years. So if we're at 37 trillion today, that means by 2034, we're going to be at $100 trillion of debt. What do you think the liquidity is going to be, global liquidity at that point? So yes, I do believe that gold and Bitcoin both have massive legs higher here. But I think that Bitcoin has a higher leg on it because it's in the midst of its early adoption. And and more people understand it, more and more people adopt it, and more institutions start to adopt it, that's going to just drive that price higher because there's only so much available. And so what you'll see is over the course of the next 10 years, you'll start seeing major companies adopting Bitcoin as part of their treasury strategy. And I'm not talking about the current treasury strategy that we're seeing out there today. I'm not talking about MicroStrategy and some of the other Bitcoin treasury companies. That's a different thing that I'm talking about. Those are specifically designed to arbitrage capital markets to buy more Bitcoin. Different.
You're talking about random companies on the S&P 500.
I'm talking about companies like Apple or Microsoft that say, we need to have 2, 3, 4, 5% of our treasury in Bitcoin, and get it out of some of these longer term bonds that we can't trust because our purchasing power from holding those long term treasuries is just eaten away. It's destroyed. So we don't want to hold any of that. And so, and there will be enough of a risk in U.S. Treasuries at that point that you'll see investors start easing out of that and buying things like Bitcoin and gold. But Bitcoin's so much easier to deal with, and so you'll start seeing that.
Bitcoin potentially, $1 million, 2030, 2032. How does gold perform in that scenario? It's going to underperform Bitcoin, I think. You expect it to?
I think it'll underperform Bitcoin, but it will still be growing quite a bit because what you'll see over the course of the next 10 to 20 years, this whole fiat experiment it could be on its last legs here. Now, that does not mean that I expect hyperinflation for the US dollar anytime soon. Right. But I do expect that this debt issue that we have is not U.S. centric. It's across all the entire developed world. I just showed you we have $300 trillion of debt that's sitting there. 300, I think it's now 324 trillion is the last metric I got. So Jesse has to update his chart here, but of global debt. And so what does that mean? That means that we're borrowing from the future. It means that we have to debase every single currency that debt is based in, which means that we need high structural perpetual inflation. There's just no way around it. Yeah. And what benefits from that? Gold does. It will continue to benefit from that, meaning, though, that it's not really benefiting. It's just that you're just seeing the decline in these currencies. It's not that gold is getting more expensive. It's that all of the currencies that are being used to buy it are becoming worth less and less, and people are realizing that. And so you could see gold go on a real tear here. But if and when you do, Bitcoin it usually follows gold. It will follow it and then rip past it on a percentage basis because, again, it's much more scarce. There's an actual hard limit on Bitcoin. And then there's nowhere near the same amount of paper that there is in gold. So in those markets. Phenomenal.
James, where can our viewers, subscribe to your newsletter and learn more about your services and your fund and what's going on with the fund? Before we sign off, what's the latest on the Bitcoin Opportunity Fund?
Yeah, so the Bitcoin Opportunity Fund, we just launched Fund 2, and we've gathered about 20% of our goal already. So we're excited. And so what that is, it's a public and private investment vehicle, just like it's a hedge fund, and we invest anywhere in the Bitcoin space. We can do public, we can do private, early stage, late stage. But typically, what we're focused on is, Alex, we're focused on later stage companies. So we're not doing a lot of venture. There's just too much speculation in this space, we feel, at this point, to feel comfortable with that. And we just feel like there's a little bit of a mismatch between the life cycle of these companies that doesn't really match the life cycle of a 7 to 10 year fund. That just doesn't, because these companies are more like 10, 12, 15, 17 years. And so we expect some of these funds to have to extend their terms. But so what we are is we're focused on what we like to say is real companies with real revenues and real profits. So the majority of them are public. And some of our private companies are done through PIPEs or private investments that will become IPOs or publicly traded securities at some point. But that's what we're doing. The second fund is it's open to accredited investors. It's not my rule; it's the SEC's rule. But if anybody has interest in that and feel like they would like to talk to us about that, we can just go to bitcoinopportunity.fund and fill out the little your name and we can get back to you and have a call with you and talk about it and see if it's something that would be appropriate for your investing style or your portfolio. And then the Informationist is the newsletter that I write every Sunday. And awesome. And like you said, it takes one topic that's kind of complicated and simplifies it for people, for everybody. And that's been great. It's already over, like you said. I'm shocked, but there was a need for simplifying this terminology for people, and so it's got over 40,000 subscribers. I'm very thankful for that. I'm flattered. So, and that's just at jameslavish.com. It's on Substack. So there's a free version and a paid version. So
amazing.
That's
wonderful, James. I really appreciate you coming on. I learned a ton. Again, thanks so much for your time.
I appreciate it, Alex. I look forward to the next time.